Your bank is paying you 0.38% on your savings. The exact same government backing pays nearly 10 times that. Same country, 10 times. They are not hiding it. They are just quietly betting you never go looking. By the end of this, you will know exactly where that missing money went. I am not here to sell you a bond fund. I am here because bonds are the one market that prices everything else you own. Your mortgage, your car loan, your job security. Most people skip bonds because someone told them bonds are boring and safe. One of those two words is a lie. Start with the number that should annoy you most. $10,000 in the average savings account earns you $38 a year. The same $10,000 in a short treasury bill earns a few hundred. Nobody committed a crime here. The bank just borrowed your money cheap and lent it back out expensive. That gap is the business. Think of your savings account as a parking space, not an investment. Parking is fine. Paying rent to park is not. Here is the honest part. Moving that money takes about 20 minutes. But first you need to know what you are actually buying. So what is a bond when you strip the jargon away? A bond is a loan. You are the lender. The government is the borrower. That flip is the whole thing. You become the bank. They take your cash, then hand it back on a date. Fixed is the word doing all the heavy lifting. Because once that payment is locked, the world keeps moving around it. And that is where it breaks. This market is bigger than every stock market on the planet combined. And almost nobody watching this has ever looked at it. One rule runs the entire thing. Here it is. When interest rates rise, existing bond prices fall. Not sometimes, always. This is arithmetic, not opinion, and it never takes a break. You hold a bond paying 3%. New bonds start paying 5%. Now nobody wants to buy yours at full price anymore. So the price drops until the math is fair again. That is the rule. Now watch it reach your house. Your mortgage rate is not set by your bank. It shadows one treasury yield. Lenders take that yield and stack their margin on top. 0.5% more costs a typical buyer over $100 monthly. Across 30 years, that same 0.5% quietly eats a small fortune. Nobody asked you. A market you never watched decided. Now here is the part that hurts retirees. Bonds were sold as the seatbelt, the calm half of your portfolio. In 2022, stocks fell and bonds fell with them. That year, the seatbelt caught nobody. Long-dated bonds had their worst year since 1754. 13 colonies existed. That is the comparison. The word nobody explained to them was duration. It is a risk dial. Duration measures how hard your bond gets hit every time interest rates move. Low duration bends a little. High duration simply snaps. Two people, same money, same year, and one loses nearly triple the other. The difference was one number on a page. There is one more trap, and it is common. Hold a single bond to maturity, and you get your money back. The price can swing. The promise still lands. A bond fund never matures. There is no date. There is no promise. It just trades, which means it behaves like a stock. Safety came from the deadline. Remove the deadline and you kept the low return but lost the guarantee. So what would I actually do with this? Move your emergency cash into short treasury bills, not a savings account. 2. Before you buy any longer bond, look up its duration number first. 3. If you need a certain amount on a certain date, hold to maturity. That is it. No product, no affiliate link. Bonds are not boring. They are the hidden price tag on everything else you own. Your mortgage, your savings, your retirement. One market. The bank was never lying to you. It simply never volunteered the truth. Now you know. That is the whole difference. Understand the boring stuff first, and the rest of money stops being a mystery.